Cory Shepherd here with the Your Business, Your Wealth show. And we've been getting some questions around basics of personal finance and some requests to answer these. They're topics that you might have been wondering about for a while, and they're not something that we usually tackle on our full show. So I want to give you some short answers here to some of those basics to help broaden that knowledge for everybody that's listening. So we're going to start real basic with simply what's a stock and what's a bond. So a stock is a share of ownership in a company. You buy a share of Apple, congratulations. You are a part owner of Apple, and you get a vote in telling the board of directors how to run the company. Of course, there are about 4.5 billion shares of Apple outstanding, so one vote doesn't exactly get you a whole lot of say. But that's okay. Most people don't buy a stock to try to control a company. They just see a company that they like how they're doing business, they want to buy into that company to hopefully participate with the growth of that company over time and see the value of their money grow. Of course, that is the risk of individual stocks, because if that company doesn't do as good as we thought or goes completely out of business, then the price of your share and the value of your money can go down or even all the way to zero. Now, a bond is not a share of ownership, it's a share of a debt. So when you buy a bond from a company or from the government, it's nothing more than an IOU saying how much money they're going to pay you back over time, for how long, and with how much interest. Now, if you want your money back faster, you can sell that IOU to someone else, but this is the risk of bonds, because depending on what's going on in the market and the overall economy, interest rates, the performance of that company, then you might not be able to sell that bond for enough to have gotten all your money back. Now, a startup company, a company that's newer, that's on shakier ground in its business, they're going to be riskier than a larger company, or say the US government, which is considered a low risk bond because they've got such a long track record of paying back their debts. So a risky company, a startup, they're going to have to pay a higher interest rate to try to incentivize people to take the risk of buying their bonds. So there's stocks, there's bonds. We're going to be coming back with more answers to your questions. If you've got some specific ones, write a comment below, share this with someone who you think might enjoy it. And this is Cory Shepherd for Your Business, Your Wealth, and we'll see you next time.